Hi, this is Sam Roki. Thanks for joining me today. I'm continuing my series on life insurance provides solutions. And you've heard me talk, if you've been listening to our past videos, on this idea of what a great estate planning time period this is. I want to share with you an idea that is specific to the time. It leverages low interest rates. Low interest rates help with estate planning, and it really helps with funding large life insurance premiums. And so I have an example here of a high net worth or even kind of an ultra high net worth individual. So this may look like one of your best clients, or you may have attorneys that you call on that have clients that look like this. But if clients like this aren't looking at using low AFR rates, which is the minimum rate that you can loan to a family member or a trust while still being considered a loan, if they're not looking at these ideas, they really should be. And so I wanted to share with you this idea. So I've got a hypothetical 70-year-old couple. Their net worth is $50 million, right? So they're very high net worth. They don't have any permanent insurance, but they would like to have $10 million of coverage so that they can use that to pay estate taxes. They are very liquid, though. And so this is an idea for a way that they can take their liquidity and avoid using any of their estate tax exemption. It may be that they want to use their exemption for something else, and maybe that they should use their exemption because they might lose it, which is great. But this idea allows them to plan and to get the $10 million of life insurance without using that exemption. And so here's how this idea works. So the grantor of a trust, an irrevocable trust that goes to their next generation, or either it could even be a generation skipping trust to the third generation. He makes a really large loan. So he makes this loan of $5.4 million. Right now, the long-term AFR, so the long-term minimum interest rate, is 1%. So he makes a long-term loan to his trust of $5.4 million at 1%. So what he needs to do to satisfy that loan is every year he needs to gift $54,000 to the trust, and the trust is going to pay it right back to him in interest, which is easy to do. And if he has enough beneficiaries to cover the $54,000, that $54,000 doesn't use his exemption or require estate tax, gift tax. The trust then takes the $5.4 million and buys a $15.4 million life insurance policy. And so at death, his estate gets paid back the loan, and the insurance policy pays a net $10 million death benefit to the trust. Now, keep in mind, this idea can be scaled. It can be done with $1 million or $2 million. It doesn't have to be with $5 million. That's just how my math worked out here. But let's look at the scorecard here. So at death, the $5.4 million, it comes back into his estate, but it was already there, right? It was already there because he had it in his estate he could loan to that trust. So that was already in his estate, but look at all the growth that he transferred out of his estate. He transferred $10 million income tax-free and estate tax-free down to his next generation to provide whatever liquidity he may have needed at his death. And he used no estate tax exemption. To get a comparable $10 million policy that he'd pay all years and have to gift money to a trust every year would take about $250,000. And to get that $250,000 a year into his trust, he's either going to have to do a lot of different estate planning, or he's probably going to have to pay gift tax or use his exemption on that. This idea allows him to avoid using that exemption, but still get that $10 million death benefit. So think of your high net worth clients, your ultra high net worth clients, or attorneys that you know that work in that space, and talk to them about using some type of a private loan strategy like this to get the life insurance that they need. Because loan interest rates like this 1%, probably won't be around forever. So with that, give us a call. We'd love to discuss a case with you. Thank you.